But still in the thick of earnings, let's address one more set. And we've got Kamlesh Gandhi, the CMD at MAS Financial Services, joining in on the show right now. Kamlesh, hi, morning. Good to have you on the show. You've guided for a 20 to 25% AUM growth previously, but the growth has actually come in at the lower end of the guidance range. Tell me, what's the reason behind that? And when do you think you will actually achieve that 25% AUM growth?
Good morning. So we have been sharing this since long that 20 to 25% growth is the function of the overall macro environment of the country. We prioritize risk and profitability over just the AUM growth. So we have made it amply clear that when the things are challenging as it is now, especially in the segment where we are serving, we will be growing at a lower end of the spectrum while maintaining the profitability and the asset quality. And when the things are favorable, we'll be at growing at the higher end of the spectrum. So this is in line with our strategic intent of prioritizing risk and profitability. That is evident from the fact that even during this time, the quality of the portfolio has been maintained, and so has the profitability also been maintained.
All right, Kamlesh, the other thing I wanted to understand from you is with respect to your NPAs, because if I look at the number, your NPAs have risen. Which segments are contributing to this particular stress? If you can give us some sense there.
As you know, we are a multi-product company. Majority of our business comes from MSME business, plus accompanied by wheels and some portion from salaried personal loan, which is less than 10%. So if you see the rise in the NPA has not been that steep, and this has been contributed across the segment in more or less the same proportion, while commercial vehicle had shown a slightly higher uptick as compared to other products.
Okay, let's move away from that, Mr. Gandhi, and also share with us what is leading to the improvement on the NIMs and what are you going to be guiding for FY26. Along with that, also wanted to understand your outlook on the branch count. We understand because of some regulatory issues, the branch count addition has been moderate, but what's the outlook going ahead?
So in terms of NIMs, as we have shared earlier, that we are shifting more towards our direct distribution as compared to our NBFC distribution. So that is helping us to improve our NIMs. So as the operational cost increase, keeping our ROA at a stable level. On the branch expansion, it has nothing to do with the regulatory concerns. It has more to do with the macro environment. Last quarter, we could not find a conducive environment to expand the branches, which we would have liked to under normal circumstances. So we'll still wait for a quarter or two before we go for the expansion as per our targets.
Mr. Gandhi, could you highlight what segments do you see contributing to your growth going forward?
I think if you see the last quarter where we registered almost 19.5, say close to 20% growth on a Y to Y basis, MSME had contributed 60% of that growth, and the 40% has come from the other products. I think that trend to continue. We are specialized MSME finances, while we are very circumspect in extending credit even during this tough time. As I shared, we have maintained the quality of the assets. So going forward, we see MSME contributing substantially to the growth of the company.
Along with that, Mr. Gandhi, your subsidiary, that is Maswin Insurance, has received an in-principle approval from IRDAI to operate as a direct insurance broker. When should we expect this business to contribute in a meaningful way to your overall business?
It is at least a few quarters away. Still, some formalities have to be completed. We have got the in-principle approval. So I think we will take a quarter to complete all the other formalities and get the license going. And after that, we'll be concentrating more on our captive business. So it should not take much time before we really scale up the business there from our captive activities. And once we stabilize on the captive business, we'll be doing the open market business also. So gradually it will grow. But now the focus is more on the captive business.
And Mr. Gandhi, also help us understand in terms of your eligible demand, when do you see that rebounding and when can we see a meaningful improvement in the portfolio quality?
See, as we know that this sector has been facing a lot of headwinds and lenders have been facing a lot of problems in terms of the asset quality. It depends from lender to lender, depending upon the strategy to extend credit during good times. As a practitioner, I will tell that what we are facing is because of the our own doing of very aggressive lending, where few of the players were very aggressive in lending during the good times. It will take its own time. We still see a quarter or two for things to come back to not at least normal, but to stabilize. And then we can see things improving from there on. Because this over leveraging cycle has been there since last year or so now. And I think it will slowly tend to end, and prudence will prevail among the lenders to extend credit where it is due. So combination of all these factors should see eligible demand coming back, but at least 2 quarters away.
Okay, Mr. Gandhi, great to have you on 18 Hour today. Thanks for your time as always.
Thank you. Thank you so much.